Inflation refers to the rate at which the general level of prices for goods and services rises over time, resulting in the reduction of purchasing power of money. It's typically measured by indices like the Consumer Price Index or the Wholesale Price Index. Demand pull inflation occurs when demand for goods and services exceeds supply, driving up prices. Cost push inflation is caused by an increase in production costs, such as raw materials and wages, leading businesses to raise prices. Built-in inflation results from a feedback loop where higher wages lead to increased spending, raising prices further. Monetary inflation arises from excessive money supply in the economy. Creeping inflation is characterized by slow and steady price increases, often seen as healthy for the economy. Galloping inflation involves rapid price hikes that can disrupt economic stability. Hyperinflation is extreme inflation where prices skyrocket uncontrollably. Deflation is a decrease in prices, opposite to inflation, which can signal economic stagnation. Moderate inflation can stimulate investment and spending, while higher inflation erodes purchasing power and increases living expenses. Inflation reduces the value of savings, but can encourage investment in assets that appreciate with inflation, such as real estate and stocks. Inflation disproportionately impacts lower-income groups and can weaken the value of a country's currency internationally. The Consumer Price Index tracks changes in the prices of a basket of consumer goods and services, while the Producer Price Index measures price changes from the perspective of producers. The GDP deflator reflects inflation across all sectors of the economy. Price changes are closely tied to inflation, but can also occur due to factors like technological advancements, changes in consumer preferences, or market disruptions. Supply chain disruptions, such as natural disasters, wars, or pandemics, can lead to shortages and price hikes. Technological innovations can reduce production costs, leading to lower prices. Government policies, including taxes, subsidies, and regulations, can influence prices, while greater market competition often drives prices down. Price fluctuations affect consumer behavior and purchasing decisions, and companies adjust pricing strategies to adapt to market conditions. Persistent price changes can signal shifts in economic health. Governments and central banks use tools like monetary policy, which involves adjusting interest rates and controlling money supply, and fiscal policy, which includes taxation and government spending to influence economic activity. Price controls are temporary measures to cap prices during crises, and supply-side interventions aim to improve production efficiency and reduce costs. Inflation and price changes have shaped economies worldwide, with notable instances including the Great Inflation of the 1970s, triggered by oil price shocks and loose monetary policy, hyperinflation in Zimbabwe during the 2000s due to economic mismanagement, and deflation in Japan in the 1990s, which resulted in a prolonged economic slump. Recent inflation trends have emerged due to the COVID-19 pandemic and global supply chain disruptions, leading to higher inflation in many countries. Inflation and price changes are interconnected phenomena that reflect the dynamic nature of economies. While inflation can stimulate growth, excessive inflation or erratic price changes can destabilize economies, impacting individuals and businesses alike. Understanding these concepts is crucial for policymakers, investors, and consumers to navigate economic challenges effectively.